Picture this. It's Thursday morning, October 22nd, 1987. The world is in financial chaos. The Dow Jones has just crashed 22% in a single day, the worst single-day percentage decline in stock market history. While most traders are paralyzed with fear, one man walks into the S&P pit at the Chicago Mercantile Exchange. His name is Lewis Borsellino. In the next 13 seconds, he will make a trade that generates $1.5 million in profit, equivalent to nearly $6 million in today's money. But here's what you don't know. Immediately after making that trade, he walked to the bathroom and threw up. This isn't just another success story. This is a masterclass in trading psychology, risk management, and the razor-thin line between fortune and devastation. Because what Lewis experienced in those 13 seconds wasn't euphoria, it was terror. And that terror holds the key to understanding what separates professional traders from everyone else. Today, we're diving deep into the mind of a trader who commanded 10% of the S&P 500's daily volume, who made $4 million in a single year at age 28, and who learned lessons about trading psychology that every modern trader needs to understand. Because while the markets have evolved, human psychology hasn't changed one bit. The making of a trader. Lewis Borsellino never intended to become a trader. Like many of us, his path was carved by circumstances beyond his control. Fresh out of college with dreams of becoming a lawyer, his world shattered when his father was murdered just 2 days after graduation. Suddenly thrust into survival mode, Lewis found himself driving trucks for his father's small trucking company while studying for the LSATs. But fate, as it often does in trading, had other plans. A casual conversation while playing handball led him to the Chicago Mercantile Exchange for the first time. When Lewis opened that door to the trading floor, something clicked. The energy, the emotion, the raw sound of money changing hands. It was intoxicating. But what he didn't realize then was that he was walking into the greatest psychological training ground in the world of finance. The floor of the CME in the 1980s wasn't just a marketplace. It was a gladiatorial arena where hundreds of traders battled for scraps of profit in organized chaos. Standing in octagonal pits, they used hand signals and shouted orders to trade contracts worth millions. A single miscommunication could cost fortunes. A moment's hesitation could mean the difference between profit and ruin. Lewis started at the bottom as a runner carrying paper orders from desk to pit. Then he became a clerk, organizing orders for brokers. Each role taught him something crucial about the psychological demands of trading. He was learning to function under pressure, to make split-second decisions, and to manage emotions when enormous sums were at stake. But perhaps most importantly, he was developing what every successful trader needs: the ability to compartmentalize fear and greed. Because on the trading floor, those emotions don't just cost you money, they can destroy careers in minutes. The psychology of risk. What made Lewis different from the hundreds of other young men trying to make it on the trading floor? It wasn't his education. He was an economics and political science major with no formal training in finance. It wasn't connections. He came from a working-class Italian family. The difference was psychological. Lewis had been dealing with adversity since childhood. When his father went to prison during Lewis's elementary school years, he learned to adapt. When controversy followed his family, he learned to compartmentalize. When tragedy struck with his father's murder, he learned that survival meant moving forward, despite emotional trauma. These weren't pleasant experiences, but they forged something essential in Lewis's character: emotional resilience. While other traders might panic when positions went against them, Lewis had already learned to function under extreme stress. He understood that dwelling on losses was a luxury he couldn't afford. This psychological foundation became crucial when Lewis started trading seriously. The S&P 500 futures pit was the most volatile, high-pressure environment in the trading world. Fortunes were made and lost in seconds. Traders who couldn't handle the psychological pressure were quickly eliminated. Lewis developed what he called his rules of trading, psychological principles that kept him grounded. Rule number 1: if you lose your discipline, your ass will follow. This wasn't just colorful language. It was a recognition that trading success depends entirely on psychological control. He set daily profit targets and stuck to them religiously. If he made $5,000 by 10:30 a.m., he would leave the floor. Why? Because he understood that greed was the enemy of consistent profits. The trader who tries to maximize every opportunity usually ends up giving back their gains. But Lewis also understood something that most retail traders today still struggle with: position sizing relative to psychological comfort. He had a simple test. If holding a position made him feel like throwing up, it was too big. The market doesn't care about your risk tolerance, but your psychology does. And psychology drives decision making. The art of reading the room. While modern traders stare at screens filled with indicators and charts, Lewis learned to read something far more valuable: human emotion in real time. The trading pit was a psychological laboratory, where fear and greed were visible, audible, and exploitable. When institutional orders hit the pit, Lewis could see the immediate impact on trader behavior. A large sell order would create panic, traders scrambling to get out of long positions, voices rising, body language shifting. But Lewis learned to read between the lines. Was this real selling pressure or just temporary order flow that would reverse? His edge wasn't just informational, it was psychological. While smaller traders panicked during volatile moments, Lewis remained calm. He understood that the biggest opportunities came when others were most emotional. When fear gripped the pit, that's when logical thinking became most valuable. This ability to stay emotionally detached while others lost control became Lewis's signature. He developed a reputation for being aggressive when necessary, but also for being utterly reliable. In a world where handshake deals moved millions of dollars, trust was everything. The pit also taught Lewis about the hierarchy of confidence. Successful traders commanded respect not through aggression, but through consistency. When Lewis made a trade, others knew it was solid. This psychological currency was more valuable than any technical analysis. But success in the pit required more than just emotional control. It demanded physical and mental stamina. Trading was game day every single day, as Lewis put it. The adrenaline, the pressure, the constant decision-making. It took a toll. By the end of his career, Lewis was getting tension headaches just pulling into the parking lot. This physical response to psychological stress is something every trader needs to understand. Your body keeps score, and chronic stress will eventually impact your decision-making ability. Lewis stayed in peak physical condition, not for vanity, but for performance. The million-dollar moment. October 1987 was unlike anything the financial world had ever experienced. The market had been volatile for weeks, and Lewis had already made substantial profits trading the chaos. But when Black Monday hit, October 19, 1987, the entire global financial system seemed on the verge of collapse. The Dow Jones Industrial Average fell 22.6% in a single day. In today's terms, imagine waking up to find the market had dropped from 35,000 to 27,000 overnight. Panic was everywhere. Many traders were forced out of the pits because their clearing firms couldn't meet margin requirements. The survivors faced unprecedented volatility. Lewis was in Europe when the crash began, enjoying what should have been a relaxing vacation with friends. But when he saw the Swiss ticker tape showing the Dow down 500 points, an unthinkable number in 1987, he knew he had to return immediately. Getting back to Chicago required a $15,000 Concorde flight from London to New York, nearly $50,000 in today's money. But Lewis understood something that many traders miss. Opportunity has a cost, and the cost of missing an opportunity can far exceed the cost of seizing it. When Lewis finally returned to the pit on Tuesday, October 20th, the scene was apocalyptic. Half the usual traders were gone. Those who remained were shell-shocked. But Lewis saw something different: inefficiency created by emotion. Thursday morning arrived with markets still reeling. Lewis walked into a pit filled with fear and confusion. The normal crowd of 400, 500 traders had shrunk to barely 200. Order flow was chaotic. Market makers were overwhelmed. Then it happened. A Shearson broker entered the pit with what appeared to be a massive sell order. The opening was going to be ugly. possibly 5,000 points lower. In the normal world, this would represent certain disaster for anyone holding long positions. But Lewis made a split-second psychological calculation that would define his career. Despite the terror gripping everyone around him, despite the fact that the world seemed to be ending, he saw opportunity where others saw only catastrophe. Someone behind him offered to sell 300 contracts at the low. Lewis bought them all. In the 13 seconds that followed, as the market bounced violently, Lewis had made $1.5 million. But here's the crucial detail that reveals everything about trading psychology. Immediately after realizing his profit, Lewis walked to the bathroom and threw up. This wasn't celebration. It was the physical manifestation of understanding how close he had come to losing everything. The psychological paradox. Lewis's reaction to his greatest trading triumph reveals a fundamental truth about professional trading that most people misunderstand. The best traders aren't fearless. They're afraid all the time. They just don't let fear paralyze them. When Lewis bought those 300 contracts, he wasn't confident the market would bounce. He was making a calculated bet based on decades of experience, reading market psychology. But he also knew that if he was wrong, he could lose everything he had worked for up to that point. This psychological tension, operating with confidence while acknowledging the possibility of catastrophic loss, is what separates professionals from amateurs. Amateur traders either trade with false confidence, ignoring risk, or become paralyzed by fear, missing opportunities. Professionals live in the space between these extremes. Lewis's physical reaction also illustrates something else crucial: the human cost of high-stakes trading. Making $1.5 million in 13 seconds sounds glamorous, but the psychological stress of operating at that level is enormous. It's why Lewis developed strict rules about position sizing, profit-taking, and risk management. Success in trading isn't just about making money, it's about being able to continue making money over time. And that requires protecting your psychological capital as much as your financial capital. The euphoria that followed Lewis's success was equally dangerous from a psychological perspective. At 28 years old, having made $4 million in 1987, worth nearly $20 million today, it would have been easy to believe he had found the secret to unlimited wealth. But Lewis understood that markets humble everyone eventually. His response to success was as disciplined as his response to loss. He bought real estate, invested in exchange memberships, and diversified his income streams. He understood that trading profits are ephemeral, but building lasting wealth requires moving beyond trading. Lessons for modern traders. What can today's retail traders learn from Lewis Borsellino's journey? The markets have changed dramatically since the 1980s. Electronic trading has replaced the pits. Algorithms execute trades in microseconds, and information flows instantly around the globe. But human psychology remains unchanged. First, understand that trading success is primarily psychological, not technical. Lewis succeeded not because he had superior analytical tools, but because he had superior emotional control. He could make decisions when others were paralyzed by fear or greed. Second, respect the market's power to humble anyone. Lewis was one of the most successful traders of his generation, yet he still had losing streaks that kept him awake at night in cold sweats. If you think you've figured out the market, you're probably about to learn a painful lesson. Third, position sizing is everything. Lewis's rule about position size was simple. If it makes you feel like throwing up, it's too big. Your psychology drives your decision-making, and oversized positions cloud judgment. Fourth, focus on the process, not the outcome. Lewis didn't go to the floor thinking about making millions. He went with a plan to execute trades according to his rules. The money was a byproduct of disciplined execution. Finally, understand that sustainable trading requires treating it like a business, not a get-rich-quick scheme. Lewis succeeded because he approached trading professionally, with proper risk management, clear rules, and realistic expectations about the psychological demands. The trading world still looks for the holy grail, the perfect system that generates profits without risk. But as Lewis learned over his 22-year career, there is no holy grail. There's only discipline, risk management, and the psychological fortitude to execute your plan when everyone else is losing their minds. The 13 seconds that made Lewis $1.5 million weren't lucky. They were the culmination of years of psychological preparation. And the fact that he threw up afterward wasn't weakness. It was wisdom. Because in trading, the moment you stop being afraid is the moment you start taking risks that will eventually destroy you.